Good morning, kia ora. I found Roger's presentation this morning quite fascinating, not least the slide that talked about automation and over the next 10 years, the Oxford University study. I think if you'll note, there were actuaries in the top 10, underwriters, brokers, and claims assessors. I'm an actuary by trade, so I'm fourth from the top, so I'm desperately finding a way to stay relevant, and basically that's my role, working with Aon Benfield. My actual presentation is entitled Insurance Innovation, Disruption or Creative Destruction. Insurance innovation is typically considered an oxymoron. I'd be interested from the audience though, who of you in the audience, being the best and brightest from the industry, who actually thinks we are a staid, conservative and slow to adapt industry? Don't be shy. Wow, that's a bit higher than I thought. I don't think we are. Who thinks the perception is that we're conservative, slow? That's right, it should be pretty much everyone. And a lot of what I'll talk about today is really that, you know, the industry does have a conservative reputation, but it has masked a track record of innovation. So we can look at a little at the past, but then also look at some of the opportunities in the future. And Chris Black opened the conference today by saying, you know, challenge presents opportunity, and I firmly believe that in our industry. The industry is challenged, challenges in growing in the underwriting part of the P&L, in the investment side, obviously low interest rate environment, and then there's the external factors, the disruption that we've been hearing about this morning, and I'll touch on that. But like I say, there is opportunity. I don't think, the challenge is there's not too much capital. I actually think we're not offering products to meet the demand that's out there. So let's take a look at a very simple framework for the industry. At the core, again, we've heard a lot this morning about data and analytics. And we see data and analytics as really facilitating the transfer of risk from supply to demand. If you bundle data and analytics with the supply side of the equation, you get an insurer or a reinsurer. If you bundle it on the demand side of the equation, it's really the advisor or the broker that's bringing that risk to market and facilitating that connection between supply and demand. And the need for advice on both sides of that equation is important. What we've seen over time, though, is demand and supply effectively taking the intermediary out, particularly in personal lines, which are large, homogenous portfolios of risk, where it has been disrupted. And it's been disrupted for some time through online platforms and bringing that risk directly to market. Where we do really play a part is looking at the large, complex risks and the need for advice around facilitating the placement of complex risk. And that's where I believe the industry will still play a significant part in the future. So insurance is a product for an imperfect world. And what I mean by that is, you know, with increased uncertainty and volatility in the marketplace, it should be a long-term tailwind for the industry. I liked, again, Roger's comment this morning. He used the acronym VUCA: volatility, uncertainty, complexity, and ambiguity. That is where, as an industry, we should be taking charge in this increasingly risky world. If we look at a quick snapshot of the industry, global insurance premium over $5 trillion, capital at 4.3, profitable, combined ratio less than 100, and still showing some growth in global insurance capital. What is relevant, though, there is what we're seeing in terms of new capital and innovation. And we are tracking the broader ecosystem and trying to understand what the disruptors and the startups and the innovators are doing and how they are potentially impacting the industry. So we think at least 200 startups, and just in 2015, $2.6 billion invested in insurance disruption in 2015. $9 billion invested over the last 2.5 to 3 years. So plenty of activity targeted at the insurance sector. And another form of disruption we've seen is also from alternative capital in the reinsurance sector. So bringing capital to reinsurance, something like $75 billion of capital out of a total of what we think is about 550 billion. So a significant component of capital being put to the reinsurance sector is now coming from things such as pension funds, sovereign funds, looking for alternative, non-correlating investments in the insurance sector. So we're seeing capital, but we're also seeing technology and expertise coming to the sector. And why are those disruptors coming to the sector? What are they actually looking to disrupt? A few words on this slide, but I'll cover it at high detail. They're looking to disrupt all elements of the insurance value chain. Now, when we consider the insurance value chain, there's five key components there. There's the customer, and the customer is the source of the ultimate risk. Insurers access the customers directly or through advisors or brokers. There's claims. Some would argue that is fundamental to insurance, the promise to pay. It's where the value lies. And claims is often seen as the core of what an insurance company does, providing indemnification to the customer who has suffered from an adverse event. Capital. Capital is the actual deployment of risk-bearing capacity and provides value to customers through liquidity and financing. And it's obviously regulated as well. Regulators, rating agencies, and many companies adopting an internal economic view of capital as well. Investment, the business of managing insurance assets. But I think when we look at the value chain, there's been a lot of research done by academics, and I think one element that they tend to miss is what we've called paper, which is the ability to be able to offer and write an insurance product. There's not many companies that can provide that. It's a regulated component, and some would say that the industry to some extent is protected by regulation in offering the ability for the insurance industry to be able to offer that paper. And so that's quite an important component of an insurer's value proposition, being able to have that ability to offer the paper. So the expenses that come from the value chain, and I'll talk about the numbers later, but if we think about customers, expenses are coming from broker and agent commissions. From the paper perspective, it's underwriting expense, it's bureau and associations, licenses and fees, and some would say there's an implicit cost of compliance as well in dealing with regulatory considerations. Claims perspective, all the claims adjustment services and related IT expenses. And then investments, the cost of trading, and capital is obviously the expected cost of capital. So they're the elements that the disruptors are seeking to disrupt. And what we're seeing is headlines such as these are increasingly common. Can insurers afford outside disruption? We've heard already about autonomous vehicles, and we've heard about cyber. So again, many headlines in not just the insurance press, but the broader press about disruption to the industry. Who's heard of Clay Christensen? Anyone? There's a few hands in the audience. He's a professor at Harvard and has examined disruption in many industries. He found that new technologies overturned the big incumbent companies in industry after industry were not necessarily better or more advanced. It's just that the incumbents missed the opportunity. And one particular quote he has is, "The new products were low-end, dumb, shoddy, and in almost every way inferior. But the new products were usually cheaper and easier to use." And so again, we're seeing a lot of that disruption in the startups coming to the industry. They're looking to simplify what actually is quite a complex product. And so his conclusion was the experts in incumbent companies are not necessarily the best positioned to see disruption coming. So it does take sometimes an external view to look at how we can disrupt the industry. So who is disrupting? There's a whole bunch of names on this slide that we've classified at the top there along customer, paper, capital, claims and investments. And as I mentioned earlier, we're monitoring startup accelerators and incubators and seeing what the venture capitalists are doing and where are they investing. And as you can see from the chart there, pretty much all elements of the value chain are up for disruption. However, there is a focus on the customer, on the distribution effectively. That's where we're seeing a lot of the new technology, the startups targeting that distribution element. We've heard some names already this morning. We heard about Lemonade, who's looking again at providing a more efficient insurance platform and product. You may have heard of Metro Mile in the US, who is effectively offering a time-dependent product rather than an annual policy. So looking at a usage-based component of insurance. We heard about Slice, the on-demand or providing product for the sharing economy. And Trove is another one, looking at the ability to insure specific products for a specific amount of time and making that process extremely easy through a smartphone-enabled app. So again, just offering easy to access, simple product. And that's where we're seeing a lot of the disruption, predominantly in the customer, but also looking at a reimagination potentially of the insurance company model. So they're the names that are disrupting or starting to disrupt the industry. They're leveraging technology, they're leveraging data and analytics and bringing that to bear in the marketplace. And there's a whole swathe of underlying technology that is also being developed or also potentially has application to the industry as well. So many of you would have heard of blockchain and its ability potentially to make the audit process more efficient, but also to build in a smart contract element into the way that insurance companies operate, a more efficient way to actually provide a product. So why are they actually disrupting? We've talked about the elements earlier: customer, paper, claims, investments, capital. What we've outlined here, and this is based on the US industry statistics, a major component of the global insurance market and a wealth of information that we can access, is we can actually look at the expenses associated with each of those elements. So if you look at customer, for example, the percent of net earned premium that's devoted to distribution, acquisitions, costs, etc., is a third of the overall expense. And that's where the startups are looking for that efficiency, to drive that customer efficiency. Paper's about 10%, claims 12%, investments 0.7%, and capital 9%. Overall, every dollar spent on insurance, about 50% goes to expense. So in that context, you can see why the startups, the accelerators, the innovators are looking at disrupting the industry. They see an opportunity for efficiency and an opportunity to unlock value. If we can strip out some of that expense and reduce costs, you can see the short-term differentiating play and access to market that the disruptors actually have access to. So the question is, if you were to start a new insurer and having a look at the numbers on that chart, how would you change your actual business model? How would you try and get that expense down so actually more of every dollar that's spent on premium is targeted to actually offering the insurance product, rather than at the moment, almost 50% of premium is targeted expense? It's a significant component. Taking all that into account, one of the questions I ask myself is this innovation actually driving growth? And I think it's an important question. We've talked about distribution and stripping expense from the system, but does the innovation drive growth? So what I've done here is picked out some startup quick pitch narratives, which you'll typically hear. So a better insurance experience through education and a simpler buying process. Comparison and shopping guides, online and mobile insurance marketplaces, peer-to-peer insurance built by pooling friends and acquaintances to spread risk, technology solutions, new coverages and products, on-demand, micro-duration insurance coverage that we discussed earlier, and safety and telematics, monitoring commercial drivers' alertness, giving drivers live feedback to reduce the cost of the insurance. And I guess the observations there are, a lot of the disruption is still focused on the customer-focused disruption of the value chain, rather than fundamentally improving or expanding the value being delivered by insurance. And it's targeting personal, small commercial lines, distribution, and it's simplifying that product complexity. But is it growing the market? And that's a question I would pose, and we'll talk about that in a moment. a lot of it seems to be around tweaking and optimizing the existing product that we have, but delivering it more efficiently. So within that context and within the paradigm of looking to strip out costs from the system, insurers should be thinking about their fundamental business, taking that startup mentality, how would you build a new company from scratch? And that continued evolution beyond just being a risk transfer player, but being a risk advisory and risk management player. And I think that's been one important element of the industry, is that we are one of the few industries where that premium actually puts a cost to risk, right? So it's not just the cost of risk transfer, but you can also read it potentially as a cost of mitigation. Part of that premium can be looked at it as a cost of mitigation. So ultimately, it'll require a re-evaluation of the in-house expertise and creative consideration of non-traditional areas where that expertise can create value. And actually, we're seeing that many of those companies that we think are conservative, large, staid, they are investing and they're looking at broadening their ecosystem. So looking at who they can partner with from that page that we saw earlier. And there's numerous companies that are looking to partner with. So it's not really just an us and them play, it's actually broadening the us play and thinking more broadly about the insurance ecosystem and how we can bring and more expertise into the industry. So where are the potential opportunities for growth, and how can we leverage both the industry expertise and capital, but also the broader ecosystem expertise to actually deliver that product? Again, if we look at this slide here, which is looking at effectively P&C premium compared to GDP over the last 10 years for top 50 countries globally. Those above the line, we can say that P&C to GDP is growing, so there's a growing relevance of insurance over time. Those below the line, which include many of the more developed economies, including the US, one of the largest players, we can say there's a shrinking relevance to the economy. So relevance of property to the overall economy, of insurance to the overall economy, is actually decreasing over time. But it's no surprise that many of those above the line are actually the emerging economies, or some of those, such as New Zealand, is actually above the line. And so GDP is not the ideal proxy because it does include the economic cycle, does include increased spending following catastrophe events, etc. But it does give us a framework for considering the innovation gap. And we've heard that term a couple of times today as well. And one thing I would mention is if we look back historically, I do think the insurance industry has innovated significantly over time. It's been at the forefront of testing and underwriting risk. And just to list a few, there's vehicle and highway safety. I know we're going to hear about autonomous vehicles later. Business and home safety, crime prevention, arson control, fraud detection, workplace safety, and it's also played a part in legal and judicial reform. So to some extent it has been successful, but that success has also meant that to some extent the product has become less relevant, because with the risk mitigation measures that the industry has introduced, we've seen declining relevance of many of the product, declining frequency. So actually the core insurance product we're seeing a declining demand for. And so really we need to look at where are those gaps in the core product lines where we can offer product, and where are the emerging risks? How do we start building some capability in product to be able to offer solutions there? So back in 2015, Aon did a study which approached risk managers across numerous sectors. So at the corporate level, not the insurers level, but at the corporate level, in all manner of industries, and conducted a survey to ask them what their top risks were. For some reason, they come up with the top 53. I don't understand why 53 and not 50, but we've got 53 risks on that slide there. And you can see the top one there is damage to reputation and brand, followed by economic slowdown and recovery, all the way to the bottom right there of harassment and discrimination. So taking that list of 53 risks and thinking about where the industry currently does offer a product, and I've marked it in black. So that's got to create vast opportunity for the industry where we can play in that space. Much of it is obviously very difficult to quantify and underwrite when we think about damage to reputation and brand, but to some extent, some of the coverages the industry is providing is providing a subset of cover in that element. D&O, for example, there's an element of reputation and brand in there. So vast opportunity for the industry to offer and fill those gaps. If we reorder those, the risks that were highlighted by the risk managers, we can look at those on the left that are classified as a general business risk. We can look at those that are insurable and generally currently insured, so third-party liability, property damage, cat cover, D&O, etc. Those that are insurable, but potentially there's still opportunity for product development. So we've got business interruption, but we've heard about supply chain insurance as well earlier today. Computer crime, hacking, viruses, cyber is obviously something that's dominating the press at the moment. So there's opportunity in that column. And then there's those that potentially insurable but present design challenges. So damage to reputation, brand, failure of disaster recovery, corporate social responsibility, intellectual property data, and social media liability. So taking a look at that, there still are opportunities for the industry. And it's not just emerging risk, there is opportunity within existing or evolving risk. So we've heard about the move to autonomous vehicles. We've worked up some scenarios, and looking at the currently global insurance premium, 47%, almost half of an insurance portfolio is motor premium. It's a relatively stable, low volatility line. If you took motor away, the industry's volatility would increase by 40%. So to some extent, motor provides that buffer and provides stability to allow the industry to underwrite other risks. So with the move to autonomous vehicles over time, potentially we're going to see higher volatility in a typical insurance portfolio. So how do we manage that volatility? We've got to put more capital to it. So it becomes challenging, and we think there will be close to 100% adoption of autonomous vehicles by 2050. That's probably quite conservative. It could actually be sooner than that. 2035, so just looking ahead, so just less than 20 years, we think the premium from motor will probably reduce about 20%, and looking out to 2050, the premium will probably reduce to 40%. So a shift from the current coverages to potentially that product liability type coverage. Other opportunities in existing risk, we've seen mortgage risk in the US post-financial crisis. We facilitated the placement of almost $8 billion of credit limit into the market since 2013. So that's a new risk that's now being covered by the reinsurance market. Agriculture and food security, we do have existing coverages there, but with the population increasing to over 9 billion by 2050, it creates huge opportunities for the insurance sector to provide coverage there. And the protection gap, from a catastrophe protection gap, working with governments, public-private partnerships. If you think about over the last 20 years or so, if we look at catastrophes in the US, only 45% covered by insurance. In Europe, Middle East, Africa, about 20%, Latin America 13%, in Asia Pacific, only 10% of the economic loss is covered by insurance. So there has to be an opportunity to leverage the expertise, the data and analytics we have to grasp some of the existing protection gap across those product lines. And then, of course, we've got the emerging and new, and cyber we've talked about. 90% of the premium is coming out of the US at the moment, but that will change. We're seeing the introduction of the General Data Protection Regulation in Europe, which is looking at all corporations handling Euro citizen data will have to report data breaches. If you don't report those cyber data breaches, the penalty is something like 4% of your worldwide turnover. It's quite a stiff penalty for not reporting breaches. So it means more information in the system, the more opportunity to develop product more appropriately to respond to that information. And the growth opportunity is vast. I think in some numbers I've got here, 2015, economic loss from cyber is about $500 billion. In 5 years, we expect that to be $2 to $3 trillion. And premium is currently sitting about $2 billion. In 5 years, we expect that to be closer to $10 billion. So opportunities for the industry. So just to finish up, coming back to the original slide, this relationship here between supply and demand and data analytics as the facilitator, I don't think it will fundamentally change, but I think what we will see is how, for example, product is delivered, how we broaden the ecosystem and bring some of the startups and disruptors to actually become part of the existing insurance infrastructure. As I mentioned earlier, a lot of the disruption is focused on delivery of the product, and I think we as an industry can learn from that and looking at how we simplify the product and deliver it. So we need to incorporate that into what we do as the insurance industry. But overall, the limiting factor on growth is not really supply and demand in the equation, but it's developing a more comprehensive understanding of the underlying risk and being able to develop product and deliver that appropriately. And I think data and analytics is really going to be the key to doing that in the future. Thank you very much.